Hey, what's happening, guys? Dan Darrow here with another Options in Play video update. So, I have talked about stops a few times in the past. Right now, I thought it was a good time to go over it again because you probably have noticed me writing more about it in the nightly letters. I always write stops, I always talk about stops. Every trade has a stop for the most part. But now I'm doing something a little bit more unusual, and it's really because of the overall higher volatility environment. All right, and um, long story short, for stops, I usually like to use like one of two. So it's either a technical stop or a price point stop. Okay, technical stop meaning I'm using like a specific level on a chart. Right, so I have Moderna up here. I'm going to use Moderna as an example and talk about it. So you say you have like a specific price point on the chart. You say like if Moderna gets through 35.50, that's a stop, right? Clears 35.50, I want to be out of the trade, right? If you're thinking short. Um, Now, for options, you can't, you don't have the ability to have stops on options. So what you do is it's kind of like a mental thing, right? Where you get like the alert goes off on the stock, then you go into the option market and you close the option, right? So if it's like a put, you go into the option market and you close the put, right? Because you can't have a stop on the actual option contract, right? So when I say a stop, it means that like the stock hits the stop and then you go into the option market and close out the put. Now the other thing that I like to do is debit loss stops, right? So if there isn't a specific price point that I'm really interested in, right? Maybe I'm doing like a volatility strategy, right? Or maybe a more complex strategy that I'm not really looking at a specific price point, right? I'm looking for maybe just like a bigger move. So what I would do is like I'll use net debit stops, right? And that's basically saying that um, the net debit of the strategy is $2, say, just hypothetically, right? If it's $2 net debit, and maybe like a week later, the strategy has lost $1 and now it's worth about $1 net debit, then that overall that trade is down 50%, right? And that 50, I typically like to give them like 50-60%. Like that's kind of like my net debit stop loss range. Sometimes for whatever reason, maybe there's a huge gap and it opens up underneath that. I mean, like sometimes you can't hit that window exactly, but generally speaking, like the 50-60% net debit loss range is what I like to use. Um, and that's because on the opposite side, the 100% net debit gain range is what I like to use when I to start rolling, right? So I'm sure you've noticed that a lot of the trades, when I start to adjust them, it's when they've gained about 100%, right? So when they've basically doubled is when I like to start rolling. So if you roll at 100% and you're cutting losses at 50%, ideally if you're batting over 50, right? If your batting average is better than even, then hopefully you're coming out ahead, right? Now, right now, because what's happening, and I've talked about a lot, is that option pricing is really high, right? The implied volatility is really high. What I'm noticing is that stocks might blow through like a technical level. So I've noticed this on Texas Instruments, right? So it'll blow through a technical level, but because the option pricing and the puts, there's such a huge demand for puts. The implied volatility is remaining really firm, and they're not really um, getting hit as much as you would have expected, right? So I'm kind of using like a combination of two, and I'm actually probably more so favoring the net debit range, but right now I'm using like either or maybe like both, right? So instead of one or the other, now I'm thinking like I can use either a little bit more flexible, because the option pricing is remaining a little bit more firm, right? So like when Texas Instruments it pop through like the top of like this lower resistance range, right? Normally you would think that like downside put spreads would take a pretty sharp hit, but what happened is applied volatility remained firm, option pricing remained firm, so it almost gives you a little bit more flexibility to kind of stick with the idea, right? Using like those net debit stops, or like conversely, if the stock had just kind of bounced around, chopped around, maybe it started to lose some premium, but but the trade stuck underneath resistance, then you could say, oh, well, the thesis still stands. Maybe I stick with it because it hasn't really broken through the technical area, right? So I'm using, I'm giving them, instead of having like either a technical stop or a net debit stop, I'm kind of using the flexibility of like, trying to do both, using one or the other. Just because what I've noticed is like the option premiums are staying really firm, especially on like the put side, right? So gives you a little bit more opportunity to stick with these ideas a little bit longer because of that. All right. So I just wanted to go, like I said, wanted to go over that again because something that I've been talking about in the nightly letters. So just wanted to like clarify a little bit more the reason why I'm doing that. All right. So if you have any questions, please reach out. Happy to spend a little bit more time going over it. If you like these videos and you're looking for more information on options education or more option trade ideas, please follow up with the link in the description of the video for more information on options to play. Stay safe, stay healthy, have a wonderful night, and let's hope for some good earnings action. All right. Talk to you tomorrow.